Ladies and gentlemen, imagine waking up one day and seeing silver break through 333 per ounce, a level that shakes markets, headlines, and even your portfolio. But what if I told you that this is just the beginning, that what comes next could fundamentally change how we think about money, risk, and wealth forever? Today, we are not just talking about numbers. We are talking about the forces driving the global economy and the shocks that few are prepared for. When we look at the behavior of markets, it's essential to recognize that they are not random. They are driven by cycles that repeat with remarkable consistency. Every market, from equities to commodities, moves through periods of expansion and contraction, optimism and fear, stability and turbulence. Silver, in particular, is a market that reflects broader economic forces because it sits at the intersection of industrial demand, investment demand, and monetary hedging. By observing its past behavior, we can gain insight into where it is likely to go next. Historically, silver has shown that during periods of rising inflation or monetary instability, it becomes a preferred store of value. We saw this in the 1970s when high inflation eroded the purchasing power of currencies and silver prices surged in response. Those who ignored these signals and relied solely on historical averages missed the broader macroeconomic context that was unfolding. Similarly, during times of financial stress or uncertainty, investors flock to tangible assets, and silver often outperforms because it is both a commodity and a monetary asset. Recognizing these repeating patterns allows us to anticipate potential turning points in the market. The concept of cycles is critical. Economic growth, credit expansion, and debt accumulation inevitably lead to overextension, which is followed by deleveraging and correction. Silver, because of its dual role as an industrial and investment asset, often mirrors these cycles in exaggerated ways. During periods of aggressive credit expansion and liquidity growth, silver can remain undervalued relative to its intrinsic potential. Then, when the broader economy reaches a tipping point, be it inflationary pressure, currency devaluation, or geopolitical tension, silver can rise rapidly, often in a short burst, as the market recalibrates. Understanding these cycles is not about predicting exact prices. It's about recognizing the forces that drive them and positioning accordingly. Another important aspect is that historical extremes are more than anecdotal. They are lessons embedded in data. When silver reached high multiples relative to its historical average, those peaks were rarely anomalies. They reflected structural pressures such as loose monetary policy, geopolitical uncertainty, or disruptions in supply and demand. Conversely, prolonged periods of underperformance occurred when currencies were stable, interest rates were predictable, and confidence in financial systems was high. By studying these patterns, one can identify recurring signals that often precede major moves. These are not guesses. They are observations rooted in economic reality. Timing within these cycles is crucial, but is also subtle. Markets often discount information well before the broader public reacts. Investors who understand the patterns see the buildup before it becomes obvious to the mainstream. When silver approaches critical thresholds, such as the level we are now discussing, it is rarely a random spike. It is the result of a combination of macro forces that have been accumulating over time, forces that can be observed and measured if one pays attention to the historical rhythm of economic expansions, contractions, and crises. Those who ignore these patterns tend to be caught off guard, while those who study them gain a strategic advantage. Furthermore, cycles do not operate in isolation. They interact with global economic conditions. Silver is influenced not just by local demand or monetary policy, but by international capital flows, geopolitical events, and shifts in investor psychology. For example, when central banks pursue aggressive monetary expansion, the ripple effects are felt across commodities and currencies, creating an environment where silver can suddenly move to extreme valuations. Historical analysis shows that these periods are rarely solitary. They coincide with broader structural shifts in the global economy, signaling both opportunity and risk. Finally, the lesson from history is not just that cycles repeat, but that human behavior repeats. Fear and greed, optimism and pessimism drive markets in predictable ways. Understanding the patterns of human behavior in the context of economic cycles allows one to anticipate market reactions and prepare for potential volatility. Silver's historical behavior is a reflection of these forces. a tangible expression of economic sentiment, scarcity, and value preservation. Those who study the patterns rather than merely reacting to price movements position themselves to navigate the market with a greater sense of awareness and discipline. In conclusion, silver's trajectory cannot be understood without appreciating the repeating cycles that govern economic behavior. Its spikes and collapses are not anomalies. They are reflections of broader macroeconomic forces that have been present for decades, even centuries. Recognizing these cycles, understanding their drivers, and observing the historical patterns allows one to anticipate critical junctures and potential shocks. The market is telling a story, and by listening closely to history, one can gain clarity about what may come next, not as a certainty, but as a probabilistic understanding grounded in observation, analysis, and the patterns of human and economic behavior. When we think about investing, it's important to recognize that risk is not just about the potential for loss. It is about exposure to forces that can fundamentally alter value. Diversification is not merely a technique. It is a principle grounded in the understanding that markets are interconnected and that no single asset can consistently perform well under all conditions. Silver, in this context, is not just a commodity. It is a financial instrument that functions as a hedge against uncertainty, a store of value, and a complement to a well-diversified portfolio. Ignoring this dual role exposes investors to unforeseen risks, while understanding it allows one to navigate volatility with a strategic framework. Historically, safe haven assets emerge when confidence in other parts of the financial system weakens. Investors flock to assets perceived as reliable stores of value because they seek protection against currency devaluation, inflation, or systemic shocks. Silver has long fulfilled this role, not as a perfect proxy for safety, but as a tangible asset whose intrinsic value is widely recognized. Its performance during periods of instability is often amplified relative to conventional assets, reflecting both its scarcity and its historical perception as a hedge. Those who fail to incorporate such assets into their portfolios are effectively taking concentrated risk, exposing themselves to scenarios that historical precedent suggests are inevitable. Diversification is about more than just spreading investments. It is about mitigating the impact of tail events and ensuring that no single shock can derail an entire strategy. Silver, alongside other precious metals, plays a critical role in this framework because its behavior is often countercyclical to equities, bonds, and fiat currencies. When central banks expand the money supply or when debt levels rise beyond sustainable limits, the value of paper assets may erode. In such conditions, silver can serve as a stabilizing force, preserving purchasing power and providing a buffer against systemic instability. The principle is simple: assets move in patterns that are sometimes correlated, sometimes inversely correlated, and understanding these relationships is essential to building resilience. The dynamics of safe haven demand are not static. They fluctuate based on economic conditions, policy decisions, and investor psychology. When interest rates are low and inflation expectations rise, as tangible assets like silver gain appeal. When geopolitical tension escalates, markets anticipate disruptions in supply and currency volatility, a further enhancing demand for these instruments. This is not speculation. It is a reflection of the underlying principles that govern investor behavior and capital flows. Safe haven assets, by their nature, provide insurance against scenarios that are difficult to predict but historically inevitable. Ignoring them leaves one vulnerable to the very shocks that they are designed to mitigate. Diversification also involves recognizing that risks are multidimensional. It is not enough to allocate capital across asset classes without understanding their structural characteristics and how they respond to macroeconomic forces. Silver, for example, reacts not only to financial market conditions, but also to industrial demand, technological trends, and geopolitical developments. Its movements reflect a combination of short-term volatility and long-term strategic positioning. By including silver in a diversified portfolio, one is effectively hedging against multiple layers of risk, monetary, systemic, and structural, rather than relying solely on traditional financial instruments that may fail under stress. The behavioral component of diversification cannot be overstated. Investors often overestimate their ability to predict markets and underestimate the probability of extreme events. History shows that crises tend to be more severe and sudden than most anticipate. And the most prepared investors are those who maintain exposure to safe, haven assets like silver. These assets act as a counterbalance to human biases, fear, overconfidence, and herd mentality because they are grounded in tangible value and long-standing market perception. Diversification, therefore, is not just a technical exercise. It is a discipline informed by an understanding of both market mechanics and human behavior. Furthermore, the interplay between diversification and safe haven assets becomes particularly relevant when markets are at inflection points. When conventional indicators suggest stability, it is easy to underestimate systemic risk. However, silver often anticipates shifts in economic conditions before they are widely acknowledged, reflecting its sensitivity to both monetary policy and investor sentiment. Incorporating it into a portfolio is not about predicting exact outcomes. It is about recognizing that uncertainty is inevitable and that resilience requires proactive positioning rather than reactive measures. The patterns are clear. Those who diversify with foresight are better positioned to weather shocks, while those who do not face disproportionate risk. Ultimately, the lesson is that diversification and safe haven dynamics are not optional. They are fundamental principles for navigating complexity. Silver exemplifies these principles because it embodies both risk mitigation and opportunity. It reminds us that markets are interconnected, that cycles will continue, and that uncertainty is a constant companion in investing. Those who understand this and who allocate accordingly are not merely seeking returns. They are building resilience against the unpredictable forces that have historically shaped financial systems. In an era of unprecedented monetary expansion and global uncertainty, these principles are more relevant than ever. Markets are inherently volatile because they reflect the collective expectations, fears, and behaviors of participants responding to complex and often unpredictable forces. Volatility is not an anomaly. It is the natural outcome of systems under pressure, where multiple forces interact in ways that are sometimes reinforcing and sometimes opposing. Silver, like many tangible assets, experiences periods of extreme volatility precisely because it sits at the intersection of industrial utility, monetary hedging, and speculative interest. Understanding why this volatility arises and what it signals is critical for anyone seeking to navigate financial markets effectively. Historically, spikes in silver prices have been preceded by the accumulation of pressures that are not immediately visible to the casual observer. Monetary expansion, rising debt levels, inflationary expectations, and geopolitical tension all create